So how do you really get rich? What is the truth to getting into that elusive $20 million or greater net worth territory as a self-made person? Welcome to Analyzing Finance with Nick. This video is going to be a little bit different than some of the other stuff I'm going to make. A lot of people have asked me in my consultation forums where people reach out to me for questions about wealth management or financial planning, career guidance, or a variety of other things. This one simple question, and that is, how do I get rich? That's the question we're going to answer today. And I'm just going to give you my honest, unfiltered answer on this. And just as a disclaimer, I have not hit the rich level yet. $20 million net worth is one of my many goals. I'm in the process of doing a lot of the things I mentioned in this playbook. So you're not getting a perspective of somebody who has completed the playbook necessarily, but you're getting the perspective of somebody who understands the economics of all of this and is in the process of going through the path to wealth right now. So you're following along with my journey as being a subscriber to this channel in a way. And no, the answer is not being a famous YouTuber. In fact, I did a video literally titled "Why You Should Not Be a YouTuber." So I'm not really spoiling much there. But I just wanted to make you my perspective as somebody who is going through the process versus somebody who has completed the process. Also, my incentives are aligned with yours. I run a wealth management company, and if you all become successful, it means that I have more future high net worth clients who I am predisposed to enjoy working with, as we both like the material of this channel. So, what is it? Like, if you are somebody who grew up in a middle class to upper middle class background, or even a working class background but with little to no debt, how do I get there to the counter elite level? Well, that's what I'm going to explain. To start, there's 3 books I recommend reading, and a lot of the concepts from these 3 books I'm going to be addressing in this video. The first one is a book called How to Get Rich by Felix Dennis, and it basically explains how he was able to make a fortune off of starting several magazines. The most famous of these magazines are Maxim, PC Pro, and several other tech and bro culture themed magazines, mostly in the UK, but a lot of them spread to be popular across the English-speaking world. Another book I recommend is called The Hard Thing About Hard Things by Ben Horowitz, one of the co-founders of Andreessen Horowitz. It's about the real grind that it takes to be a startup founder and a lot of the struggles that it involves with building a business and the persistence needed to make it to the end. So that's another one I would recommend. And then the third book that I would recommend is Unscripted by M.J. DeMarco, and one that's similar to that is the book Millionaire Fastlane that he also wrote, which is kind of just to shake you into a more entrepreneurial mindset in general. These books are often perceived as a little bit heterodox, but they do go into a lot of the concepts that we're going to mention here. The other, I don't know if it's a black pill or a red pill that I got to get started with off the bat, is that the path to getting truly wealthy is not a fast one for the most part. I mean, it's faster than maybe a conventional career. It still is likely going to take far longer than you expect. At least you're going to have to sacrifice at least a decade of your life, likely living in a income range that is lower than a lot of your friends, and you're going to have to give up or delay certain milestones to really put the effort into making it to the top on the entrepreneurial world. The average person who is self-made, who hits the $20 million mark, is about 50 years old when they get there. Some people in high tech, like venture-backed startup land, and in the hedge fund and private equity and finance world can do it in their late 30s or 40s. And their professions, like people who build law firms or real estate wealth, often takes a little bit longer, to their late 50s or even 60s. I want to give you a realistic time frame. And you're also likely going to, on this path, have startups or business deals or attempts that ultimately fail. From personal experience and also with my entrepreneurial peers, it's very rare that your first business is the one that takes you to the top. It's usually your second, third, or fourth. If you understand that ahead of time, and then the general rule of entrepreneurship is everything will take you 4 times as long and cost you 4 times as much as expected, you will have a better idea of what you're getting yourself into and if it's something you really want to do. The first key step to this, as you probably can tell, that if you really want to truly get rich, is you need to be an entrepreneur and start your own company. But it's not simple as just hanging up your shingle. There's more to it than that. Example would be that you have to have a business that is potential to scale beyond yourself. In the beginning, yeah, you're going to be doing most of the work. In fact, you're probably going to be doing all the work, maybe you and your business partner, the first couple years. But you need to build a model that eventually you can replace yourself with people who are just as talented and capable, or if not more capable than you, to do very specific roles, everything you do. And the more redundant you are, the more valuable your business is if you are trying to sell it. And so that's kind of a general playbook, is building equity in a company of yours that can generate solid cash flow and or have a lot of growth potential that somebody would want to acquire from you. So that's how you do it. You need to keep enough equity while you're doing that, which is the key lesson from Felix Dennis's book, so that when the acquisition does come, you will get enough of a payout that you can retire and be above this $20 million threshold. Like, a lot of companies try to get venture capital financing very early. Unless you're an AI startup that gets a super high valuation and your relatively small piece will still be a huge amount, I generally advise against doing this, because every dollar you give up in equity to an outside investor now is going to be tens or hundreds of dollars you're giving up in the future in the exit. Like, for example, you start a company, and year one, you take $1 million investment that you give up half your equity of your company. You have a business partner, so you each have 25% left. I'm using this as simple examples. There's usually multiple parties and multiple rounds. So let's just say you get the acquisition 10 years from now. The company sells for $100 million. Instead of you getting a $50 million payday, you are getting a $25 million payday. Now, let's look at another example. Let's just say you and your business partner start a company, and then you build a minimal viable product, and you gain enough traction on your own to show that there's real potential. Like, you have your first customers, you have signs of proof of demand, it's a good working product, you put in the sweat equity and grind it on your own for the first couple years. Now you go into the venture capital market and say, hey, look, I'm not just a greenfield idea. I have a proof of concept here. So now, instead of commanding the $2 million valuation in the previous example, which is still extremely generous for a greenfield business, I'm just making these numbers easy. Let's say now you get that same $1 million that you need to scale, but instead of at a $2 million valuation, you get it at a $10 million valuation. So instead of giving away half your company, you're only giving away 10% of your company to the VC. Then let's fast forward another 8 years, you still got that $100 million exit, but now instead of getting a $25 million payday, you're now getting a $45 million payday. And There's an example. Let's just say, for example, you can bootstrap it. Like you've saved up enough money through your previous job, or you lived like a hermit for several years, or had enough ingenuity that you didn't even have to go to the VC markets at all. You now have 50 million if it's you and a business partner, or if you did it by yourself, you have 100 million on that sale. The key is the more equity you have at the end of the game, the more money you will ultimately have at the exit. And that's what Felix Dennis preached. Give all the incentives you want. Give profit sharing. Give higher base salaries if you're hiring people. Give bonuses based on hitting sales quotas or referral things. Reward them for growth, but don't actually give hard equity. That is how he had a relatively modest business in the magazine industry, but ended up far wealthier than people who built much bigger businesses, because he kept a bigger chunk of his equity than a lot of these founders. But there's a fine balance to this. It's better to own 10% of $1 billion company than 100% of a $100,000 company. If you need the money to scale, you got to get the money from outside. I'm not saying you should never take outside capital. It's just you want to take outside capital at a minimum level so that you don't dilute yourself. And the other thing too is you can lose control of your company and get fired by your investors, which is a very common issue among founders. So that's the other risk of giving away too much equity. There's kind of a trade-off there. A lot of tech companies have pressure to give away more equity because of how hyper competitive it is and how first mover advantage in terms of being like the first or second company to come in and just blitz scale and spend a bunch on advertising and promotions to get that early market share is a lot more valuable, and that puts pressure to dilute quicker. Whereas in other industries that are more established and you're going to gain your clients and customers not just through a quick blitz scaling campaign, but more through a methodical, thought out process and a sustainable moat, you don't need to give away as much equity in that case. So it's a lot of circumstantial things, but in general, the more equity you keep, the better. And that really is a big key lesson. But I mean, great, I just need to have equity in a business and have an exit in 10 plus years. But how do I get to the point where I build a business that somebody's going to want to buy in 10 years to create that exit event? And also, how can I start a business and find my initial customers and things like that? Well, I generally advise people in this kind of Venn diagram situation, you need to find 3 things to create a successful business. What can you do better than 99% or 95% of people if it's 2 like unrelated skills combined? Like it's Scott Adams' skill stack, I think is like the term for this. If you can make it to the top 1% as an entrepreneur, you have a viable business easily. For other professions, that's the other way you can get rich. There is a second way other than entrepreneurship, and that's just being like the top like 0.1% in any given profession. Whether that's an athlete, a teacher, a doctor, a lawyer. If you're the top 100 to 500 people in the world at anything, you'll get rich. I think that's much harder to do than the entrepreneurship path. The entrepreneurship path is difficult, but any other profession, if you have to be within the top 500 people, hey, even more generous, top 1,000 people, that's just all the people in the world competing to be in the top 500 in their profession. It's very difficult to do. In the age of the internet, where things are more scaled and concentrated and winner take all, it's going to get increasingly more difficult to do that kind of thing. And yeah, you can, and like that's the same thing like CEOs who make it to the Fortune 500 CEO. You are basically one of the top 500 management employees in the United States. When you look at it that way, it makes sense why they're paid so much. A lot of their decisions can move billions of dollars of market cap, and every quarterly earnings report, what they're paid is really a fraction of that. But from the more broad perspective, anybody who makes it to the top 500 individuals of anything will get wealthy if they apply themselves enough. But I can't give advice that applies to the top 500 individuals in any profession or skill. So you can be in the top 1 to 5% of one or two things, and if you're an entrepreneur, you still can get to the same level as somebody who's in the top 500 overall. The second component is what actually gets you excited to wake up at 7 o'clock in the morning. It doesn't have to be any time. I think the whole 5 a.m. club thing is just a survivorship bias meme. But the general idea is you need to have something that is going to motivate you intrinsically for long enough to see the process through. As I mentioned, the first 2 to 3 years, you're probably not going to make any material amount of money, especially net of living expenses. That's just the nature of entrepreneurship in most industries. Some people catch fire and move very quick, like the Zuckerbergs of the world who become billionaires in their early 20s. But the reason why those stories are so often repeated is because they are the exceptions. They are not the norm, even for the most successful entrepreneurs. The average billionaire is 59 years old in the United States. The average person who makes it into the $20 million club does it at about age 50. So, and they don't even often start their businesses until their 30s. So it's a long road. And pure grit is not going to be enough. It has to be something that intrinsically drives you. It's not just a simple answer like find your passion and the money will come. You need to be passionate about what you're doing, otherwise you won't stick around to when the money comes. And that's why this is important. The third component is, what do people ask you for help for? And I mean that as a question is like, where's the demand? There's a big mistake in entrepreneurship that I call the Field of Dreams version of entrepreneurship. It's based on the late 80s movie Field of Dreams, where Kevin Costner plays a farmer in Iowa. Ghosts of old baseball players say, if you build it, they will come. He has to tear down a large chunk of his cornfield to build a baseball diamond. He almost goes bankrupt and loses his family farm because they tore down so much corn to build this baseball diamond. But eventually, the ghosts of the old baseball players, including the ghost of his father, show up and play baseball there. And millions of people from around the world then go see the spirits of the old baseball players. But that's not how it works in the real world. If you have a great idea for a business and you build a website and you build a product and you register your LLC and get your business cards printed out and make yourself feel all official, and then nobody buys your product, you have no customers, you're not a real business. They call a lot of those people entrepreneurs. Is that like you created all the image, like the Instagram style, like veneer of being an entrepreneur, but you're not a real entrepreneur until you have actual paying customers. If you have actual paying customers, you're an entrepreneur. And product market fit is what this is called in startup circles, is probably the hardest thing really to find. I've struggled personally with several startup attempts. The main reason why they didn't work was failure to find product market fit. It is very difficult, especially if you're a stubborn person who thinks, I have this valuable thing to contribute. And so if people don't find it valuable, then maybe everybody else is stupid. Well, no, not everybody else is stupid. It's just that they have no need. There's no need for your product. You could have the greatest thing in the world, and if nobody wants it, it's not going to be a successful business. Like if I made a YouTube channel and all I talked about was the economies of South Pacific Islands, maybe there'd be a few people who would be interested, but I bet 99% of you would stop watching this channel if all I talked about was the economies of South Pacific Islands. If I want this channel to be successful, I need to have topics that are not only things that I find interesting, otherwise you burn out and create very soulless, uninspired content, but also what you want. So I do a mix of it. I'll pick things that I'm interested in, put in a poll, you guys vote on it, and whichever one is the highest vote is the one I'll either release first or if make maybe only that one. And so it's a hybrid of both finding the demand and maintaining my creative freedom, which in this case is I have the thing I'm excited to get up in the morning to do, and I have the product market fit. I feel like I'm pretty good at doing a lot of this stuff that I explain in terms of economics and finance and how it intersects with daily life interactions, sociology. I'm probably better than the average person at doing that. And so that's example the Venn diagram. Even though YouTube is not my primary business, it's just an easy example to explain how this Venn diagram works. And any business that's successful has to be the intersection of all three of these components. And that's the biggest challenge. And so really at the beginning, until you find that product market fit, you want to spend as least amount of money as possible. And you want to not quit your job if you're allowed to do this while having another job. This is the point where you just hunker down and keep iterating, keep testing, find cheap ways, maybe buy a tiny amount of digital ads or have a focus group to share your product and see what catches a little bit of fire. It really depends on what industry you're in. And you probably should do also in the early stages is if it's a more locally focused business, start to network with your community in different community things, whether it's local politics, local civics, your local religious groups, your chamber of commerce, things like that, so that you get a feel of the business community. And if you need services from vendors in the future, or if you provide a service that the business community would value, more of a B2B, getting to know the people in your local area is a good start, and they can help you in other markets eventually. It's a mix of digital promotion and real world promotion at the beginning of any business. You can't really rely solely on one or the other. If you start digital only, you could spend a lot of money on a lot of ads, but you're really just basically pressing your luck. If you don't have an idea of who the initial market is, you can knock on everybody's office door in the real world, but not everybody has time for that either. So you got to find the balance that's going to figure out what the product market fit really is. And that's kind of step one. And then once you do that, you build something called a minimum viable product, which is the lowest cost, quickest version of your product you get out there to either show to venture capitalists if it's something that needs a lot of scale, or banks if it needs lending, or put it in your store if it's sold in B2C, or show to prospective customers if it's B2B. And then once you have the minimum viable product and the product market fit, the next stage is scale and acceleration. You found the people who want your product. Now you got to go find where they are. Whether this is traditional marketing, whether this is sales, outreach, a variety of things. Sales is a very underrated skill, and you can get pretty close to the rich category and definitely be comfortable independent professional class or institutional professional class just on being a very successful salesperson. Sales is the lifeblood of really any startup, and CEOs of really any companies that are smaller than the publicly traded level, they're generally, their main role is business development and growing the company. If you're not naturally a good salesman, you should partner with somebody who is, or hire people who can do that for you. And pay their salespeople generously, because they'll be a lot more incentivized to do things. And pay their compensation very performance-based. Make it performance-based, but generous payouts for good performance. Because if you make too high of a base, people will get comfortable and not do anything. But if you're stingy with the payouts, people will be less motivated to work or find a different person to sell for who will pay a better payout and less focused on you. So then once you get some cash flow in, the next stage is delegation and hiring. You can't do everything yourself. If you're trying to build a multinational company or serve more than 100 clients, you are going to need to start delegating to a certain degree. And you don't have to delegate everything. Say, for example, you have a business that a lot of it is based on your personal expertise. You can still do that part of it for your clients, but you can delegate some of the stuff that is not really what people pay you to do. So say, for example, if you're a wealth manager and people pay you for your investment expertise, but you're spending half your time doing admin work or like sending onboarding forms or writing logs into your CRM. Well, you, instead of delegating by hiring other advisors to do the stuff you like to do, you first delegate the admin, which is stuff that on a per hour basis is value probably less than what you're doing, and it's stuff you don't like to do, and it can leave you more time to do the things that not only you get excited about doing in the morning, but is what your clients actually come to have you do. So in this case, you would hire the admin and back office people first, and then maybe you'd hire the business development and sales people next, and you would keep doing that, and eventually you'd hire other investment professionals to help you, but you would add your final touch at the end and your opening touch at the beginning to make sure it's your stamp of approval on things. A good book about this is called Buy Back Your Time. It summarizes how you should look at when it makes sense to delegate and outsource versus when it makes sense to do things yourself. And really, generally, you should always be looking to how to buy back your time, because the more time you can delegate to others, the bigger you can scale your business. It frees you to do things that people actually value. In the age of AI and robotics, you might not be delegating these to people anymore. You might be delegating these to AI agents and machinery, but it's the same purpose. Instead of a hiring decision, it's a capital decision. But overall, it's the same idea. Then you scale to the point that you make yourself redundant, and then you could do two things. One, you can either live off the cash flow and enjoy your life. Congratulations on being the successful business owner class. Or if the business is something that is in demand, a company with more resources can scale it to the next level, and it's particularly not tied to your personal reputation, you can sell it and sell it for a price that will put you straight into the counter elite territory. So like $50 million before tax is probably the minimum that you would need to sell a business to hit the 20 million mark, because there's going to be taxes, there's going to be M&A fees, etc. So like even if you sell it for 25 million, you're not going to get that after taxes and fees and everything like that. If you sell a business for $50 million or more, that would probably get you into the bottom rung of the counter elite territory. 100 million is probably a safe mark to get you into the counter elite territory. If you want to push it harder, that's how you get into the $1 billion territory. You either keep growing, don't sell it right away, and keep scaling it up so that it becomes a business that's more valuable, or you have a total addressable market that is big enough that you can even get to that level. Some companies just max out at certain levels. For example, a company that makes Montreal Expos hats and Montreal Expos retro gear. Let's say there's only like $1 billion worth of Montreal Expos gear that'll ever be sold in a given year because it has a relatively niche fan base. And that's $1 billion is probably, actually that's probably too high. Let's say $100 million a year of Montreal Expos gear. Your company has competitors and you get 10% of the market. So you have your revenues basically of $10 million, and you have a margin when it's a mature business of say 15%, but you're taking in $1.5 million a year net. That company probably not going to sell for $1 billion. The ceiling for a company like that is probably closer to $15 to $30 million. If you have a company that's a bigger total addressable market, let's just say like AI software that can replace paralegals and called paralegal in a box. There are hundreds of thousands of paralegals all over the world. If you can create an AI that can do their whole job for $5,000 per year, that's a much larger business. That could sell for a much larger multiple and grow a lot faster due to the infinite scalability of software. Like you don't have to have a factory to make the hats and the shirts like the Montreal Expos guy does. You can scale. And that's why a lot of the fastest scaling businesses are in the TMT sector, which is tech, media, and telecom. Like media companies could scale a lot because you only have to make one piece of content, but if you're more popular, millions of people are going to watch it versus just a couple hundred people. Nobody cares about who you are. Whereas with tech, people can download software simultaneously all over the world with no marginal cost. If you have a more physical product, you have to make things that have capital costs and marginal costs of the actual raw materials and the labor needed to put them together, or the machinery if it's a more robotics driven factory. So that's why a lot of people, and finance is the same way. Finance is a very infinitely scalable business because if you are a wealth advisor, for example, who manages $10 million and you have a 1% fee on those assets, then your total value of your business, assuming everybody's at the same fee level, which is not really the case in reality, but I'm just making examples simpler, is you have $100,000 in cash flow. Let's just say now you have the same business, but now you have $100 million in management. Now your revenue is $1 million a year, and then you get to $1 billion in assets under management. Now your revenue is $10 million a year. You might need to hire a few more people to make the business, the $1 billion wealth management firm, run, but you don't need nearly as proportionate. Like the $10 million under management person maybe needs one or two advisors. The $100 million one maybe needs a total staff of 5 people. $1 billion RA needs a staff of 10 to 15 people. The staff levels increase, but they don't increase proportionately to the assets under management. And it's the same with other world things in finance, like investment banking, for example. If you do an IPO for one of your clients, let's just say for a small IPO, like a $50 million IPO, maybe you can have 1 or 2 people do it. For a $500 million IPO, you can do it with 3 to 5 people. And with a $1 billion IPO, you can do it with a team of 10 to 20. So it's kind of the same thing. This is why finance is so lucrative, because you're getting your percentage fee on the total value of the deal or the total value of the product, whether it's an ETF, you're a wealth manager, whether you're an investment banker, etc., or even if you're a payment processor, you get that 1% of every transaction that runs through your payment processor. These are probably the most scalable ones. That's why Brian Johnson made so much money selling Braintree and why the PayPal mafia got so rich, because a lot of it is digital and automated nowadays, and there's a few interchange fees and staff to maintain it, but the operating costs for running $1 million worth of payments through your platform is not much less than running $1 billion of payment through your payment processing platform. And that's where the rub ultimately lies. That's why finance and tech often are the fastest scaling. And real estate takes a little more capital, but it's slow. But it's a similar thing. Like real estate, yeah, people always need a place to live, so product market fit's a little easier. But because of that, it's also really competitive. Like the industries that have the easiest product market fit, like restaurants, everybody needs to eat. Clothing trends, everybody needs to wear something. Real estate, people need a place to live. Without super large regulatory barriers, these are often the most competitive industries. In the case of real estate, the real estate market will be priced at a level that the margins are not too high. And so the way you make money in real estate is through scale. The amount of work to manage one apartment building is quite a bit, but the amount of work to manage 5 apartment buildings is not 5x. It is for one. And you get to see the same kind of scale. And that's how you really make money in real estate, a combination of leverage and scale. But I might get a separate video specifically about that with a real estate expert, because real estate is not really my core expertise. The other key thing that is very important for this whole thing of getting rich is to avoid losing it or several pitfalls along the way. I've already mentioned the dilution of equity. It's also personal things that you're going to have to do. Like, if you are grinding this whole time and building a business, you might miss out on certain family events. If you want a young family, it's going to, unless if your spouse is willing to work and cover most of the living expenses while you're pursuing your startup, it makes it a lot harder for you to have a family at a young age, because either one, you can't really afford to support a family by yourself if you're a startup, or two, if your spouse is resentful of the fact, and they might, because they see that you're not getting any traction for 2 or 3 years, and say, oh, he might never make it. He's just pretending to work hard and is just lazy, or I don't want to carry all this burden. There's a real risk of that. So as a result, that's a sacrifice that a lot of entrepreneurs have to make. They probably have families at later ages. I don't know the exact numbers on this, but my intuition is that's a common thing. Unless they start their company later in their 40s when they've already had their family, but then they risk their family falling apart over financial tensions caused by such a decision. So it's kind of a pick your poison type of thing. Another real risk is inferiority complex, especially if you're somebody who's talented enough to pursue one of these startups. You're likely going to make more money in the short term. In your 20s and 30s, you rise, say, from like the 50 to 60K a year level out of graduation, slowly get those raises or switching jobs, and you end up being a mid-career professional making 150, 250K in a high-cost living city, maybe 1 to 200 in a lower cost of living city. And you're not at that level, and in some of the professions like finance and tech, that can get into like the 2 to 500K even level sometimes. But the point being is you see them consistently making more money. They're able to go on nicer vacations. They're able to go skiing to Colorado on the weekends than you can't, or they're able to, I don't know, go golfing more, have a fancier wedding, drive a nicer car, live in a nicer house, or even buy a house where you're still in an apartment. That can grind people. Am I a loser that I chose this path? Especially if your first business fails, are you going to be motivated to keep going again? You feel like, have I fallen behind my peers? This is a real consideration that people don't really think about when they're going on this path to getting rich. There is major sacrifices involved. Usually you're going to be living a lower standard of living. You're probably going to have to give up some of your creature comforts in the short term, and your fans and your family might see you as an underachiever or a loser for 2, 3, 5, maybe 10 years. And do you have the stomach to go through with that? And you got to be honest with yourself, because if you don't, then you shouldn't be trying to swing for the fences, and you should just be okay with the upper middle class path. You can be in the upper middle class, make your 200 to K a year at a good job, and if you get laid off, you could probably find another one as long as you update your skills in the world of AI and make yourself more competitive, and marry somebody with a similar level of income and have a good life. But that's a risk. Once you make this money, you don't plan your finances very well. Like, you don't have an estate plan. You keep your money concentrated in your founding company. If it's a stock purchase or a cash purchase, you just spend the money on liabilities or private equity deals that are suspect, or don't invest. This is how a lot of these NBA players who make a ton of money go broke, is they don't know how to keep the money. They make all this money, but they don't know how to keep it. That's kind of funny. What I do at my company at Spirit is I help people who have liquidity events. When they make their money, I help them keep it and make sure it compounds so that they don't fall back and lose all of the gains from their success. They sacrifice 10 to 20 and maybe even more years of their life to build a successful startup. It would be all in vain. And once you sell, or you just have a comfortable cash flowing business and your business gets disrupted by technological change, which is always a risk for any business owner, you have nothing to show for it. And so prudent money management, prudent estate planning, making sure your family is all in order. Divorce is a big destroyer of wealth, and your psychology is all in line, because there's a lot of mental health potential issues when it comes to this whole thing too, which probably a whole nother video. But the idea is that keeping the money is a different challenge that is often as tough or even tougher for some entrepreneurs, especially the ones who are more naturally gifted at sales and business development, that needs to be accounted for. So yeah, overall, that's kind of a basics on the path. There's also some mindset things. For example, like in the Rich Dad, Poor Dad book review, instead of saying I can't afford it, think how can I afford it? Change a problem into a question about how you can solve the problem is generally kind of the mindset you need to be an entrepreneur. Also, you need to not feel peer pressure to achieve certain status markers, because that often holds people back from going for things or being comfortable in the relative golden handcuffs. And you just have to think, like, there's a lot of rules in society like that are ripe for disruption, but people say, oh, this is the way it's always been, this is the way you're supposed to do it. That's like, you got to think about, like, how can these things be changed or disrupted for the better? And that's where a lot of the problems that can be solved, that can make great businesses. Or think about, what can I do that adds value and helps people in a way that's better than nobody else in the marketplace is doing? And instead of thinking about, like, what can I do for myself, is like, what can I do to create enough value that I can get to the level that I want to? Because really, ultimately, being rich is creating a surplus of wealth, and you have to create a surplus of wealth from creating a surplus of value that others want. And yeah, that's another mindset thing that you kind of need to flip on this, which is very important. The mindset, the Venn diagram of what excites you, product market fit, and your talents and persistence, because it's kind of like a hockey stick. You're going to look like you're doing nothing for years and years and years, and then all of a sudden, all your work's going to pay off and you're going to get traction. Like, there's a famous saying is that, like, the overnight success took 20 years to build. I've seen that in everything I've done that has had real success, whether in my business life or my personal life. It's years of me struggling, and all the lessons I've learned and insights I've gained and all the effort I've put into slowly compounds on itself in an exponential curve that you don't see, because like 20% of 1 is 1.2, whereas 20% of a million is 1.2 million. And that just compounds and compounds. The growth rate slightly accelerates too. That's how you get real growth. The key to selling is you want to sell at the peak inflection point of growth, not after the business has matured. Otherwise, you'll get a lower valuation. But overall, that's kind of my summary of really what it takes to get rich. If you want more questions about specifically how this can apply to your talents, or if you are on this process, you want to make sure that you keep your wealth and you don't lose it due to money management issues, or you want to just have a solid plan post-exit or post-escape velocity cash flow if you just keep the business as a lifestyle business, reach out to me. I'm here to help you guys. And if you want more of these practical entrepreneurship type videos, let me know. I'll make more of them. Thank you guys all for watching, and good luck out there in the business world.